All right, welcome back to Nadlan Forum Podcast Daily. You're here with Ruby, and of course, Lior's on the line. Today we got to talk about something that seriously tripped up my friend last month, and honestly, she's not alone because nearly everyone gets this wrong. She was convinced that waiting for the Fed to cut rates would mean boom, instant drop in mortgage rates. So she hangs tight, follows all the news, and sure enough, after the Fed cut, rates suddenly jump higher. You should have seen her face, just total disbelief. I mean, it's a classic case, right?
Yeah, and I'm actually not surprised. It happens all the time. People follow the big headlines. They think the Federal Reserve controls everything, especially mortgages. But what a lot of folks don't realize is that the Fed funds rate, what the Fed adjusts, well, that's all about short-term rates, not about your 30-year home loan. The mortgage rates, they follow the bond market, which is a whole different beast entirely.
Exactly. And I always get caught out explaining this to my friends like, hang on, the Fed's just one factor. So those long-term bond yields, I still find them a bit confusing, honestly.
No, that's fair. They're tricky. Here's how I like to think about it. The bond market is reacting in real time, every single day. And it's basically trying to predict where things are heading next. So by the time the Fed actually meets and cuts rates, which by the way only happens 8 times a year, the bond market already knows, or at least it thinks it knows what's coming. Mortgage rates often move up or down before the Fed even says a word.
So my friend's big mistake, waiting for the official Fed news, was basically like showing up at a party after everyone's already left. I mean, that's a terrible analogy, but you get it, right?
No, honestly, that's not so bad. It's a good picture. By the time the Fed cut rates, the market had already anticipated it. A lot of the action had already happened. Sometimes mortgage rates even do the opposite of what you'd expect. They jump higher after a cut because the bond market is reacting to all kinds of stuff. Inflation concerns, future expectations, or even something completely unrelated. That's why there's this disconnect between the Fed's decision and what happens with mortgages day to day.
It's so funny though, because I swear every time there's big Fed news, my messages light up with, should I buy now? Or did I miss my chance? And honestly, I might be wrong about this, but it's got to be one of the most persistent myths in the market.
Totally agree. It's everywhere. It's like people think there's a direct pipeline between the Fed and their lender, but there's a big old detour through Wall Street and it ain't a straight line. So really, anyone out there waiting for the perfect Fed move to lock in a mortgage, just remember it rarely plays out exactly how you read in the headlines.
Speaking of headlines, let's get into why they confuse people even more, especially with these national surveys like Freddie Mac's. I saw all these articles last week, rates fall after Fed cut. And I was thinking, did they actually? Because the average person wouldn't guess the Freddie Mac survey is basically a snapshot from before the news even breaks.
Right. That survey, it's an average, and it always lags a bit. It tells you where rates were, not where they are right at this moment. For example, the survey last week said rates dropped to 6.26% from 6.325%. But
see, that's wild, because by the time they published that, the market had already reacted to the Fed cut and rates had gone up, right?
Exactly. The Freddie Mac survey averages rates from the previous Thursday to Wednesday. So, when the Fed announced their decision on Wednesday, the survey was already in the bag. By Thursday, headlines made it sound like things were getting cheaper. But if you called your lender that afternoon, they quote you a higher rate, not a lower one.
That's probably what happened with your buddy in New York, right? The one who thought he'd sneak in for a refinance right after the Fed cut.
Yeah, exactly. He read the headline in the morning, thought, great, let's lock it in today. By the time he got his paperwork together, rates had already spiked. It's frustrating, but the market just doesn't sit around waiting for the news cycle.
I mean, it's almost like you need a crystal ball to time it perfectly. But in reality, you've just got to watch the real-time data, right? These big national numbers, they're helpful, but they can give you this false sense of security if you're not paying attention to what's actually happening minute to minute.
And these whiplash moments, honestly, they happen a lot more than people realize. Like we talked about a couple episodes back. Staying ready, having your paperwork set, not getting caught up in dramatic headlines. That's how you take advantage of the market, not by believing every headline you read. Especially if you want to refinance or buy without missing your shot.
Totally. I think the big takeaway is don't make decisions off a laggy headline or wait for the perfect moment because, it probably already passed you by. Just be informed, watch the actual rates, and don't panic when things shift fast.
That's the best advice anyone can give right now. Honestly, the markets are always going to shift. Headlines are always going to make it look more dramatic than it really is. And most of the changes that matter happen way before the news even hits your inbox.
All right, we'll wrap it there for today. Make sure to subscribe so you don't miss our next episode. There's always something wild brewing with rates and real estate. Lior, thanks for hanging out and clearing up the confusion.
Always a pleasure, Ruby. Take care and see you all next time.
Catch you later, everyone.